Welcome, everyone. Thank you for joining. I just wanted to jump in real quick and give an updated analysis on the company Netflix. As most of you are aware, I have a large investment in Netflix. I currently have $14,000 of value in it. I just bought an additional $3,000 of Netflix, even after this recent run up, even after it being called so expensive. The more I think about this company and the more I consider the entire market, the competition, whether it's Disney Plus or HBO or Amazon or Apple, when I consider the total addressable market and their positioning in that, their business model, the leaders of the business, the downside, I like this company more and more. So even though the price is going up and I'm buying high, I continue to buy this company. And in this video, I wanted to explain why. Why am I still so bullish on Netflix? Why do I like this investment so much? Well, I want to go over it with a few bulletin points here. And what I want to do is, as I'm going through these, I want you to think about where you disagree with me, because this is really where I sit at with Netflix. This is what I think about this company overall, and I'd like to hear what your bear argument is, where you disagree with this. So let's go through a couple of these. First of all, we have 70 million Netflix subscribers within the United States, and that's their big market, their highly lucrative market. And one of the bear cases is that Netflix is saturated within the US. They're completely saturated. They're not going to grow anymore. I don't think that's necessarily true. There are right now 70 million plus cable TV subscribers, households that have cable TV and they don't have the streaming services. 70 million plus. And they have something in common. All these households that prefer cable TV have something in common. They're of an older generation. Most of the people watching cable television are an older generation. They're like the baby boomers. And we know from many studies and many surveys, and we know from a lot of the data, that Netflix is entertaining younger people. They're catching the people that are millennials and Gen Z and the upcoming households of the future. So what I see is a transition, a long tailwind for Netflix. As more and more young couples and young families form households, 80 to 90% of them are going to be streaming households. And that's going to be Netflix in the pole position there. Netflix is going to be the go-to streaming service. And then you'll have the other ones like HBO, Disney Plus, you'll have Apple TV Plus and Amazon Prime. But those will be ancillary to Netflix. I think that Netflix will be the go-to streaming service when the 70 to 80 million households that's currently on cable slowly over the years transitions to streaming. So Netflix is essentially positioned to grow from 70 million subscribers within the US to 90 million, to 100 million, to 120 million. They could grow all the way up to 140 million if all the cable TV subscribers eventually transitioned over to Netflix. And in my opinion, I think that's happening. I think this transition from cable linear television to on-demand streaming is a slow but continually inevitable process. So that's the first point that I bring up. I don't think that Netflix is completely saturated within the US. I think that growth will slow down a bit, but I think they'll have a continual tailwind of people transitioning from cable to Netflix. The other thing that I would say is that Netflix is looked at as not being the king of content. That's usually like Disney or these other big studios like Warner Media, right? That have all this iconic content. Warner Media has The Matrix and Disney has Star Wars. They're considered the kings of content. That's not true. The data doesn't support that. It's true that Disney has unique content and Warner Media has unique content, but Netflix is the king of content. And that's known by a couple different things. One of them is that they're entertaining more young people. In the past 90 days, okay, so in the past quarter of Netflix, if you actually added up the total number of episodes released by all these different services, Netflix came out with more episodes than HBO Max, Amazon Prime, Disney Plus, Apple TV, and Hulu combined. All of those combined, HBO Max, Amazon Prime, Disney Plus, Apple TV, and Hulu, Netflix came out with more content than all of those services combined. So in terms of quantity and being able to have a wide selection and a variety of content, Netflix comes out with movies, comedy specials, documentaries, kids shows, reality shows, dark dramas, everything. They have by far the widest selection of content of any streaming service. None of them even comes close in terms of content. But then not only that, when you look at the quality, it's almost indisputable at this point. They're winning more awards in terms of quality and acting and scripts than any other service. At the last Emmys, for instance, the awards given out for the best acting and the best series and yada yada, all that stuff that resembles quality, Netflix was a big winner. They won 44 awards in total. The next closest competitor was HBO Max that had less than half the amount of total awards. So Netflix is winning on both fronts. They're coming out with more content and better content. They're winning more awards. They have the quality and the quantity. There's no other streaming service that can say, yeah, we're coming out with way higher quality stuff, even though we don't make as much as Netflix. HBO is supposed to be the high quality service, but they won less than half the awards. Netflix is where you go to if you really want the groundbreaking high quality series. And I think that that's important. The company is hitting on all fronts. Now, another thing that I notice when I look at Netflix and I compare it to Disney Plus and the leadership and the management, you have Ted Sarandos, you have Reed Hastings, you have Bob Chapek leading Disney. Disney makes you pay for movies to watch on a streaming service when you're already paying for the streaming service. And as long as the movie's in the theatrical release, Disney's making you pay an extra like $30 to watch it. You're already paying for Disney Plus, but now you're paying extra to watch a movie that they're releasing on a service you're already paying for. HBO Max allows for same-day streaming as movies they're releasing in the movie theater, like these big Warner Media movies. But that's only for a month. They're only doing that for a month, and that's only during 2021. What is the only service that releases everything on their streaming service, 100% of it, all at once, and they don't make you pay any extra for it? That's Netflix. No other company is doing what it takes to actually win this game. All of them are just so stuck in this business model of the past, having to be able to still have their cake and eat it too. They want the box office. They want the streaming service. They want to milk more money out of you by making you pay extra for the streaming service. When I look at what Disney's doing, they're not all in on the streaming. Neither is Warner Media. All of them are making concessions and they're making it more complicated. Warner Media is going to offer a ad version, right, where you don't pay a monthly subscription or it's cheaper, and then you have ads in the mix. Netflix is the only company that's doing this pure business model of just having one cheap subscription, tons of content, everything released all at once. And another thing I'll mention on this note is Netflix is the only company coming out with so much content all at once, every single week, week by week, that they can dump an entire series, an entire season all at once. That leads to a lot of binge watching, leads to a lot of buzz. Look what happened with Squid Game. That was dumped all at once, and then within a couple weeks, it was a worldwide phenomenon. It was really incredible to see the growth of one series in like a couple weeks. Disney can't do that. They come out with The Mandalorian, they come out with the Boba Fett series. They only have this key content for a short while. So what do? They string you along week by week, releasing one episode at a time, hoping that that's enough for you to keep subscribed to their service, because they simply do not have the content to dump the whole season at once like Netflix. So while all these other streaming services like HBO and Disney are releasing one episode a week of a key series, Netflix, on the other hand, is releasing an entire series every week. They have 10 times the amount of content, so they can do that. They can release entire series as other companies are releasing episode by episode. Now, if we get into the actual business aspects of Netflix, we know that their ARPU, their average revenue per user, is way above the competition. It's like almost 10 times the amount of Disney's in foreign markets, and it's about 3 times in the US. So their ARPU, their average revenue per user, is a major advantage. Netflix has massive pricing power, and they're showing that by charging users more, having them stay subscribed, and even increasing the amount of subscribers they have, while having that higher pricing. Check out this image here. This is the amount of Netflix subscribers in red compared to Disney Plus subscribers in blue. Disney Plus had The Mandalorian, and they had a really good initial lead and a huge growth in subscribers. And there was a feeling that Disney Plus could surpass Netflix if they continue to grow at that speed. But in the past 2 quarters, you can see that Netflix clearly grew their subscribers more than Disney, while already having twice the subscriber base and having a higher average revenue per user. Even though they're charging more and they already have more users, they grew last quarter more than Disney. I think this graph is pretty revealing. Even though Netflix is already massive, it seems like their size can be an advantage, not a disadvantage. Disney is struggling to grow even with the content that they have being Disney, and Netflix still continues to grow being this kind of no-name company, right? They have the Netflix brand, but they don't have any type of IP like Star Wars or Marvel. They're growing this quickly with just masses of content. Now, another thing I noticed, listening to Bob Chapek interviews and comparing it to Reed Hastings, for instance, is that Bob Chapek often says things like, we're going to let the consumers decide. We're going to let the consumers decide the future of the company. And that to me is a very weak response. For instance, he's not letting the consumers decide. Netflix knows what the consumers want. They want cheap, wide variety, good quality content, lots of it dropped at the same time, not being strung along week by week, no ads. That's what they want. It's very simple. Reed Hastings understands what the consumer already wants, while Bob Chapek says that's going to be the guiding thing of the company and they're just going to look at the metrics. But Disney's not doing that. I guarantee you the consumer of Disney Plus wants the movies that are released the same day to be included with the service for free. They don't want to have to pay $35 or $30 to see a movie on a service they're already paying for. So Bob Chapek is not doing what the consumer wants in every instance. He's still stuck to this legacy kind of cable TV attitude, and I don't find that as good leadership. I think that Netflix has a better direction with the overall feelings of consumers, and they're not questioning it. They don't say, we're going to let the consumers decide. They already know what the consumer wants, and they're doing it. Now, on the note of Netflix and Disney, one thing has also become clear to me over the past couple weeks is that Netflix is going after Disney's lunch. They're literally trying to become the newer, younger Disney and have that Disney flywheel. Think about Disney as a business. Just consider this for a minute. Disney's such a strong business because of their brand value that they were able to create through a combination of park experiences, merchandise, and media experiences like movies. They combined all of that together. And the media experiences, the great movies they come out with, help sell the merchandise and help sell tickets to their parks. That's how they make so much money. It's all of it self-reinforcing. Well, Netflix is clearly trying to do the same thing, and they're trying to do it in a better way. They're trying to become the new Disney. Netflix went in and made a deal with Walmart to sell Squid Game t-shirts. They're now getting into merchandise much bigger than they were previously, and that's a big thing that Disney has historically done. Netflix is going into experiences with video games. They're releasing games for all of their key series, like Stranger Things. They're going to have mobile apps with that. And I think that this flywheel of having the media, having the merchandise, and having the experiences is clearly Netflix trying to steal Disney's lunch and mimic their same business, but an updated version of it. They don't have all the same ties that Disney does holding them back. So I see this venture of Netflix going into both merchandise and video games to reinforce their IP as something very positive and very promising for the company. I really think that Reed Hastings he's not settled. He's not happy just being a streaming company. He wants to be a global entertainment company that has dramatically surpassed Disney, improving upon their own business model. And I think that he has the drive and the direction to be able to accomplish this. Netflix as a company recently just surpassed Disney's market cap. So obviously they're creating value, and I think this will continue. Now, outside of that, another just side note I would mention is Netflix seems like a very resilient, recession-resistant business. By that, I mean that if the economy was to take a big downturn and GDP slowed and people started losing their jobs and interest rates went higher and money wasn't so cheap, that's when you want safe investments, companies that can really stand on their own two legs. And Netflix is certainly one of those companies. I think it would be looked at as almost a safe haven during times of recession because people want the most voluminous, cheap form of entertainment, which is certainly Netflix. There's no other way that you can entertain a family that has nothing to do because you're laid off or you're fired or times are tough, better and cheaper than Netflix. So I also see this as a business that's good to own during economic downturns and upturns. I think that in both scenarios, this business is great to own. Just another positive to keep note with Netflix. So this is kind of my quick thoughts on Netflix overall in terms of qualities of the business. Just overall the business, what they're doing. Just to review, Netflix has long tailwinds of growth even within the US. As more people transition from cable to streaming, I think Netflix will be one of those streaming services that are in every household. They're entertaining the younger generation, not the older generation. They are the king of content, both in terms of quantity, variety of selection, and quality. They're winning more awards than any other service, which of course creates more buzz and creates more subscribers. They have roughly double the subscribers of Disney Plus, but they're still growing strong. Last quarter, they grew more subscribers, and they're projecting 8.5 8.5 million subscribers next quarter. That's pretty good growth. They have the leadership, which is laser focused. They already know what the consumers want. They're not saying, oh, we're going to let the consumers decide, and they're not giving wishy-washy answers. They base their entire service around what consumers want. Their ARPU, their average revenue per user, is much higher than competitors, generating real cash for the company to reinvest back into its other business ventures. They're building an entire ecosystem and flywheel of experiences and products like Disney already has. And they're a recession-proof business. If they're not recession-proof, they actually excel during recessions and times of distress like they did in 2020. That's the quick list of qualities that I see in Netflix. Now, of course, we want to look at the valuation and the fundamentals of the company. For this, I'm going to be using Qualtrim Insights, which is a stock market information tool that you can use if you're part of the Patreon. So if you want to use Qualtrim Insights, you can try it out for free with the link in the Patreon in the description below. Let's go ahead and look at a couple things here. Netflix has a market cap of $300 billion. Their forward PE ratio is 52, which seems pretty expensive, a 52 PE ratio, but it also has a price to sales of 10.5. To me, that's not outrageous for a subscription business with low churn and these type of qualities. A 10 price to sales isn't too bad. In fact, Netflix in the past has had many occasions, many times over the past years, where they've been trading at a 10 price to sales, and the stock continues to perform really well, even trading at that price. So in terms of valuation, I think it's a little expensive, right? It's an expensive company, but when you actually factor in the quality surrounding the business, I don't think it's then as expensive as everyone thinks it is. For instance, Amazon right now is trading at a 54 PE ratio. That seems kind of expensive as well, but given the qualities of Amazon, I also don't think this company is really that expensive. Now we can look at some of the other metrics with Netflix. The revenue growth. This is off the charts good, continues to grow. Quarter over quarter, very consistent growth in their top line revenue. We can look at the EBITDA. Their EBITDA is growing like crazy. We can look at their free cash flow. Their free cash flow is finally moving into the positive on a yearly basis. This is quarter by quarter, and you can see the improvement over the past couple of years. We can look at their net income. The net income continues to increase dramatically, and this is what brings down that PE ratio, even though the stock is getting more expensive in total terms. We can look at the debt over time. This was the big bear case of the past. The bear case for Netflix historically was that the company has so much debt. They can't possibly manage this amount of debt. Well, they're managing it. They're producing free cash flow even with this staggering amount of debt of $21 billion. And you can see that the debt is going down. They're not raising additional debt. They're not going back to the debt market to fund their business. Over the past 4 quarters, their debt has steadily declined. This is a huge, fundamental, positive movement with Netflix. While their debt is going down, their cash balance has gone up over recent years. It's currently at $7.5 billion. They have a lot of cash on hand. And then we can look at their earnings per share. You can see the explosive growth in their earnings over recent years. This is something that we see only with a few companies that have the characteristics of high fixed costs but low variable costs. Once they get to a certain size, their earnings per share just explode. And you can see this with Netflix. It was virtually flat for year after year for almost 2 decades. Their EPS didn't really grow that much. Even though their subscriber gain was continually increasing, their earnings per share just stayed pretty flat overall. And then in the past couple of years, it's really exploded because all of a sudden they hit this critical point where they're now growing past their fixed expenses. They're not raising any more debt. They don't have to spend too much more on content, and they continually gain millions of additional subscribers funding this high EPS. And I expect this to continue in the future. I think that Netflix's EPS growth is going to surprise to the upside over the next 5 years. Another thing we can look at in terms of the qualities of the business is the shares outstanding over time. We can see if the business is diluting the shareholder or whether or not they're doing share buybacks. And for a long time, Netflix was funding their content and building out all their series by issuing more shares. So they were diluting shareholders, and you can see the growth in their shares over time. This starts at 430 million. It goes all the way up to 443 million. So this graph shows a trend of them diluting the shareholder. But then 3 quarters ago, right here, you notice the trend reversing. This is when they hit the peak of their shares outstanding, and now they're starting to do buybacks. Again, they don't need to raise capital through debt or share buybacks. So overall, pick any of your fundamentals, and all of them look amazing. The EPS is growing like crazy. The debt's declining. The net income is growing. The revenue is growing. The EBITDA is growing. The free cash flow is growing. The cash balance is very healthy and very consistent. And the price to sales, in my opinion, is not unreasonable. So again, I view all of this using Qualtrim Insights. If you want to try this tool out, there's a link in the description below. But I think what this does is it illustrates a point that Netflix overall, in my opinion, is a high quality business trading at a reasonable valuation. The people that have been critical about the valuation, for instance, like Morningstar, that says that Netflix is super overvalued, while that may be true, maybe Netflix is super overvalued, but they've been saying that for a long time. The red line is the fair value estimate from Morningstar. The black dots here are where the actual stock is trading at. Notice that Netflix, since 2015, in the eyes of Morningstar, has continually been overvalued this entire time. But the fair value estimate from Morningstar is continually being placed higher and higher and higher. It went from $69 a share to now $275. All the while, Netflix is overvalued. So I see this as Morningstar continually trailing the actual valuation of Netflix, and the trend is pretty clear. This company is creating more value as time goes on. I expect to see more capitulation from Morningstar in the future. I expect to see them continually adjust their fair value estimate up a little by little, following the actual value of Netflix. And I just don't buy it. I think this company has so many long-term growth prospects. In 10 years, I think it will have 500 plus million subscribers, maybe way more than that by that point in time. And I just want to own a bigger chunk of it now. I think that it will give superior returns than most of the market with less actual business risk. There is risk in the near term evaluation. Netflix is a very volatile stock. It trades up and down like crazy, but that's not how I do investing. I invest based off the long-term characteristics of the company. And in my opinion, I think this is a great one. So I hope you enjoyed my quick thoughts on Netflix. That's just a quick look over the company. I'll be doing more of these in the future, but that's a reason that right now I'm not only bullish on Netflix, I'm becoming more bullish and I'm putting more money into it. And if you want to see more updates like this in the future, just make sure you subscribe to the channel and I'll see you in the next one.